In this section, we will explore how India's GDP growth rate has rebounded from a -6.6% contraction in 2020 to a 6.1% expansion in Q1 2023, beating market forecasts and becoming the fastest-growing economy in the world. India's GDP growth rate reflects the performance of its economy, which is driven by various factors such as consumption, investment, exports, imports, government spending, and inflation. Let's look at some of these factors and how they have contributed to India's economic recovery. One of the main drivers of India's GDP growth is consumption, which accounts for about 60% of the economy. Consumption was severely affected by the COVID-19 pandemic and the lockdowns imposed to contain it. However, as the vaccination drive picked up pace and restrictions eased, consumption demand gradually recovered in 2021, and according to the OECD data, India's private consumption expenditure grew by 8.7% in 2021 and 7.4% in 2022, after contracting by 9.1%. Another key driver of India's GDP growth is investment, which accounts for about 30% of the economy. Investment was also hit hard by the pandemic and the uncertainty it created for businesses. However, as the economic outlook improved and confidence returned, investment activity also picked up in 2021, and according to the OECD data, India's gross fixed capital formation grew by 10.9% in 2021 and 8.9% in 2022, after shrinking by 14.5%. A third driver of India's GDP growth is exports, which account for about 20% of the economy. Exports were also affected by the pandemic and the disruption it caused to global trade and supply chains. However, as the world economy recovered and demand for goods and services increased, India's exports also rebounded in 2021, and according to the OECD data, India's exports of goods and services grew by 13.8% in 2021 and 10.4% in 2022, after falling by 13.6%. A fourth driver of India's GDP growth is government spending, which accounts for about 10% of the economy. Government spending was one of the few sources of support for the economy during the pandemic, as the government announced various fiscal stimulus measures to mitigate the impact of the crisis on households and businesses. According to the OECD data, India's government final consumption expenditure grew by 11.8% in 2021 and 6.9% in 2022, after increasing by 2.9%. A fifth driver of India's GDP growth is inflation, which affects the purchasing power of consumers and producers. Inflation was relatively low in India during the pandemic, as demand was weak and oil prices were subdued. However, as the economy reopened and demand recovered, inflation also rose due to supply-side constraints and higher commodity prices. According to the World Bank data, India's consumer price inflation averaged at 6.6% in 2020, 5.4% in 2021 and 5.1% in Q1. These factors combined have resulted in a remarkable turnaround for India's GDP growth rate, from a -6.6% contraction in 2020 to a projected growth of around 8.7% for the full year of 2021. This makes India one of the few major economies to achieve a positive growth rate in both years despite the pandemic. Moreover, India's GDP growth rate has continued to accelerate in Q1 2023, reaching 6.1% year-on-year, higher than an upwardly revised 4.5% in Q4 2022 and well above market forecasts of 5%. This makes India the fastest-growing economy among the G20 countries and puts it on track to achieve a projected growth of around 7% for the full year of 2023. India's GDP growth rate has thus rebounded from a historic slump to a record high within a span of 3 years, demonstrating its resilience and potential as a global economic powerhouse. India's GDP growth is not a fluke but a result of sound economic policies, structural reforms, and resilient consumer demand. In this section, I will explain how these three factors have contributed to India's impressive economic performance and why they will continue to do so in the future. First, let's look at the economic policies that have enabled India to recover from the COVID-19 crisis and achieve a high growth rate. According to the Economic Survey 2022-23, India has adopted a counter-cyclical fiscal policy that increased public spending on infrastructure, health, social welfare, and rural development. This boosted aggregate demand and supported the recovery of key sectors such as construction, manufacturing, and services. The survey also highlights the monetary policy measures taken by the Reserve Bank of India, RBI, to provide ample liquidity, lower interest rates and ease financial stress for borrowers. These measures helped revive credit growth, especially to the micro, small and medium enterprises, MSME, sector, which grew by over 30.5% on average during January-November 2. Let's examine the structural reforms that have improved India's productivity and competitiveness. The Economic Survey 2022-23 identifies 6 areas of targeted reform that can raise India's potential output and create more jobs. These are land, labor, power, exports, innovation and financial sector. Some of the key reforms undertaken in these areas include the enactment of farm laws to liberalize agricultural markets, the introduction of labor codes to simplify labor regulations, the launch of production-linked incentive (PLA) schemes to boost manufacturing, exports, the promotion of digital platforms and startups to foster innovation and entrepreneurship, and the recapitalization and consolidation of public sector banks to strengthen the banking system. Third, let's explore the consumer demand that has driven India's economic growth. India is primarily a domestic demand-driven economy, with consumption and investments contributing to 70% of the economic activity. With an improvement in the economic scenario and the near-universal vaccination coverage, consumer confidence has rebounded and people have started to spend on contact-based services such as restaurants, hotels, shopping malls and cinemas. Private consumption as a percentage of GDP stood at 58.4% in Q2 of FY23, the highest among the second quarters of all the years since 2013. Moreover, the return of migrant workers to construction activities helped the housing market witness a significant decline in inventory overhang to 33 months in Q3 of FY23 from 42 months last year. These trends indicate a strong and resilient consumer demand in India. To conclude, India's GDP growth is not a fluke but a result of sound economic policies, structural reforms and resilient consumer demand. These factors have enabled India to overcome the challenges posed by the pandemic and emerge as one of the fastest-growing economies in the world. As long as India continues to pursue its reform agenda and leverage its demographic dividend, it can sustain its high growth trajectory and achieve its aspiration of becoming a $5 trillion economy by 2025.